The market never whispers, it shouts. It shouts in ways most folks don't know how to hear, and price gaps are one of the loudest signals you'll ever see on a tape. You can study all the averages, the earnings reports, the opinions of men who think they know, but when a stock leaps over its old price without even trading in between, that's the market telling you something important. That's no accident. That's conviction. Today we're talking about the psychology of price gaps, why they predict explosions, and it ties right back to the previous video on catch explosive trends before they run. Because what is a gap if not the footprint of urgency before a run? Now let me ask you, have you ever watched a stock close at one figure and the next morning it opens 2, 3, maybe 5 points higher, and you sit there scratching your head, wondering what just happened overnight? That moment, that little space on the chart, is not just empty air. It's emotion. It's fear. It's greed. It's money pushing past hesitation. The man who ignores it is blind to the real currents under the surface. A tape reader worth his salt studies those gaps as if they were confessions straight from the market's heart. Think of it like this: when the crowd is evenly matched, buyers and sellers haggle over every tick. Back and forth, like two wrestlers locked on the mat. But when something decisive enters, a flood of buy orders, or panic-stricken selling, the balance breaks. The price doesn't bother to tiptoe through the old range, it vaults over it. That's the gap. Now tell me, if a stock can't even find sellers at yesterday's close, doesn't that mean something about the appetite of the crowd today? When I was young in the bucket shops, I used to watch the chalk boys mark the tape. Every so often, a stock would jump so suddenly that they had to rub out half the last column and write in a new figure. That was the kind of move you remembered. It meant big operators were at work, and if you think the game has changed just because we trade on screens instead of chalkboards, you're fooling yourself. The principles are the same. Supply and demand, human emotion, they don't change. Price gaps are the smoke before the fire. A stock that gaps up tells you that demand was so fierce it couldn't be satisfied in yesterday's range. Buyers had to pay more just to get in. That's strength. And if you're wondering, does every gap lead to riches? No, but enough of them signal the beginning of something powerful, if you know how to read them. The trick is to separate the noise from the real signal. Ask yourself, what kind of gap is this? Is it born of panic, of exhaustion? Or is it the first cannon shot in a campaign that will carry the stock much higher? Consider the opening gaps after earnings. The amateurs think, well, the news is out. The move has already happened. They think the meat is gone from the bone. But I've made my largest winnings not on the news, but on the reaction to the news. Because a gap isn't just about a report, it's about the psychology behind it. Who's in a hurry to buy? Who's in a hurry to sell? That urgency leaves its mark, and don't you want to be aligned with urgency, not against it? I'll tell you another thing gaps test your discipline. Most men see a stock leap, and they freeze. They say, it's too high to buy now, I'll wait for it to come back. But in speculation, the thing that feels safe is often the dangerous path. The thing that feels scary, the stock running away from you, that's often the real opportunity. Because if you wait for the perfect pullback, you may be waiting forever while the stock marches on without you. Haven't you seen it? Haven't you sworn at yourself for letting it slip? Now, don't mistake me. I'm not telling you to chase every runaway horse. A trader who buys gaps blindly is no better than a gambler throwing dice. You've got to judge the context. Was the stock already in an uptrend? Did the volume swell with the gap? Is the move breaking out of a base? Or is it leaping after a long run, gasping for breath? These questions matter, because a gap at the start of a campaign means fuel in the tank. A gap at the end often means exhaustion. Do you see how that works? You have to train yourself to think in terms of campaigns, not single battles. A stock that's been consolidating, building strength quietly, will often gap when the pressure can't be held any longer. That's the powder keg exploding. That's when you must act. But a stock already inflated, with every amateur piling in, when that gaps, it's usually the last hurrah before the collapse. The tape tells you which is which, if you'll only listen. Think Think about it in human terms. Picture a crowd waiting outside a theater. The doors open, and the first few rush in. That's the normal open, tick by tick. But sometimes the doors burst and hundreds charge through all at once. That's the gap. It shows not just interest, but desperation. And in the market, desperation is energy. Wouldn't you rather have that energy working for you instead of against you? Now let's tie this back for a moment. In that earlier talk on catching trends before they run, I told you the big money isn't in the buying or the selling, it's in the waiting. Well, gaps are one of the signs that tell you the waiting is over, the move is starting. The fuse is lit. The men who ignore those signs will always be late to the party, arriving after the best profits are already gone. Doesn't that remind you how patience and vigilance connect in this game? One of the hardest lessons for a trader is to trust the tape more than his own opinion. Your mind will argue. It will say, this move is too fast, it must come back. It will whisper, I'll wait for a better price. But the tape doesn't care what you think. If the stock gaps higher and holds that ground, that's strength. If it gaps lower and can't rally, that's weakness. Plain as day. The man who fights it loses. The man who accepts it profits. Which kind of man do you want to be? Price gaps are also warnings. A gap against your position is the market tapping you on the shoulder saying you're wrong. Don't argue. Don't hope. Don't reason with it. Cut it. Fast. Because if a stock can skip over your stop, leaving you behind, it means the crowd is stampeding. You'll get trampled trying to stand in its way. Haven't you seen traders cling to a losing position, only to watch the gap widen and their account bleed? That's the tuition of stubbornness. A successful trader respects those warnings as much as he welcomes the opportunities. It's all the same thing, the psychology of the crowd manifesting in the tape. Some gaps are doors opening, others are doors slamming shut. But every gap is information. Every gap is truth. And the market only rewards those who act on truth, not on hope. The irony is that most men look at charts but don't really see. They treat a gap like a hole in the data, when in fact it's the most valuable part. It tells you the crowd's hand, exposed for a brief second. It tells you what they couldn't hide, and that's where the edge lies. Because the public is always late, but the tape is always early. If you learn to read those gaps, you're learning to hear the market before the crowd catches on. Isn't that the real edge every trader dreams of? I've seen fortunes made by those who studied gaps. Not by trading them recklessly, but by recognizing their meaning in context. It's the difference between a skilled general and a raw recruit. Both see the cannon smoke, but only the general knows if it signals victory or retreat. Trading is war, and every gap is a cannon shot. Learn which ones to follow, and you'll always be ahead of the mob. And let me remind you, wealth in this game is not about one trade or one lucky streak. It's about discipline, about repeating the right actions until they become second nature. Gaps are just one of those actions, one signal, among many, but if you master them, they'll keep you aligned with the strongest moves. And strong moves are where fortunes are built, not in the chop and churn, where most men lose themselves. Wouldn't you agree that catching one real move beats chasing a dozen false ones? A gap is never just a blank space on the chart. It's a revelation, a signpost, a clue left behind by the market's hand. And nowhere does that truth become clearer than when you study the difference between a gap that breaks out of consolidation and one that leaps after a long, extended run. The context changes everything. Without context, a gap is noise. With context, it's the market shouting at you. And the trader who learns to distinguish between the two finds himself on the right side of the tape more often than not. Think about a stock that has been moving sideways for weeks or even months. The price drifts within a range, up a little, down a little, but never making a decisive move. That is consolidation. It is the market's way of catching its breath, of building pressure, of digesting the past move. Most traders get bored during these periods. They complain nothing is happening. They wander off to chase action elsewhere. But the patient trader, the tape reader with eyes open, knows that this quiet period is the market winding the spring. And when that spring snaps, it rarely does so gently. Now picture what happens when the price suddenly gaps above that range. It doesn't trade gradually through the ceiling of consolidation, it jumps over it. That's no accident. That's no trick of chance. That's a sign that the buying force, pent up for weeks, finally overflowed. The sellers who were holding the line at the top of the range get overwhelmed in an instant. Demand vaults the price to new territory. That is a powerful signal. That is the kind of gap that can mark the beginning of a campaign. Don't you see how much stronger that is than a stock already inflated, gapping even higher after it's run too far? Every campaign has a rhythm, like a story with chapters. The consolidation chapter is quiet, but it's where positions are accumulated. Strong hands use the boredom to build. They buy without drawing too much attention, without running the price up prematurely. The public yawns and walks away. Then, one day, the dam breaks. Orders flood in. The stock gaps out of the range. That's when the real move begins. And if you've been watching, if you've been patient, you know this isn't the end, it's the start. Contrast that with a stock that has been climbing steadily for weeks, maybe months. Each day it inches higher, and the public grows more excited. The newsmen sing its praises. The amateurs pile in, late to the party as always. Then one morning the stock gaps up sharply again. But this time the context is different. This time the spring isn't coiled, it's already stretched thin. That gap, instead of being the launch, is often the climax. It's the final rush of enthusiasm before exhaustion sets in. Haven't you seen it? The stock gaps up on excitement, only to stall and reverse in the days ahead. The psychology is opposite in these two scenarios. In consolidation, traders are doubtful, hesitant, unsure. The gap breaks that hesitation, showing conviction has finally arrived. In the late stage run, traders are overconfident, euphoric, chasing what they should have bought weeks ago. The gap there is the last burst of greed before the inevitable correction. The tape is the same, a blank space between yesterday's close and today's open, but the meaning is entirely different because of the context. This is why a trader must not read gaps in isolation. A single day's tape is just one note, you must hear it in the whole melody. A gap out of a base is like the drum beat signaling the march has begun. A gap after a long parade is the trumpet sounding the end, and the trader who confuses the two will find himself buying tops and selling bottoms, always one step behind. Patience is the key in consolidation. Most men can't wait. They want movement every day, excitement every hour. But speculation isn't about entertainment. It's about waiting for the right moment when probability tilts heavily in your favor, and a breakout gap from consolidation is one of those rare moments. It's the market telling you, now the waiting is over. The campaign is starting. That's the moment you act. Doesn't it make sense that big money is made by acting only at those moments, instead of wasting capital on meaningless swings? When you study past market leaders, the same pattern shows again and again. A stock rises, then consolidates, then gaps to a new high. That gap often launches a move that lasts weeks or months. It's as if the stock was storing energy during the quiet phase, then releases it all at once. The public, distracted by other noise, misses it. The professional, watching quietly, seizes it. That's the difference between fortune and frustration. Think of it like a volcano. Pressure builds beneath the surface, unseen by most. For a long time, nothing seems to happen. Then, one day it erupts with force. The gap is the eruption. The quiet before was the consolidation. If you judged only by the eruption, you'd think it came from nowhere. But if you watched the signs beforehand, you'd know it was inevitable. Trading works the same way. The gap is violent, but the build-up was patient. Do you see how this rhythm repeats in market after market, cycle after cycle? Another key to reading consolidation gaps is volume. When a stock gaps out of a base on heavy trading, it tells you demand is not just strong but broad. Many hands are pushing. That confirms the move. But if the gap is on thin volume, be cautious. That may be a trick ahead fake, not true urgency. The tape doesn't just speak in prices, it speaks in the weight of orders. You must learn to hear both. There's also the matter of follow-through. A real consolidation gap doesn't just open high, it holds the gain. It may even advance further that same day. It It refuses to retreat back into the old range. That shows strength. That tells you the operators behind it are serious. A false gap will open high but fade quickly, retreating back into the range by the close. That's weakness. That's your warning not to be fooled. The tape gives the verdict swiftly if you're paying attention. Many amateurs ask, why not just wait and buy later, once the gap is tested? That's their fear speaking. They want safety assurance. But the truth is, the strongest moves rarely give much chance to climb aboard later. They move fast, leaving doubters behind. The professional learns that when the right gap appears in the right context, hesitation costs more than risk. He acts, not recklessly, but decisively. Isn't it better to ride with conviction than to be left chasing shadows? This is where money management enters, because no gap, however perfect, is guaranteed. The trader must protect himself, always. That means placing stops, keeping risk controlled, never betting more than he can afford to lose. But within that framework, he must not hesitate. The man who waits for perfect certainty will never trade. The man who balances risk with decisive action will prosper. Gaps from consolidation reward that mindset again and again. The emotional challenge is greatest here. When a stock has been quiet for so long, the sudden gap can feel unbelievable. Traders doubt it. They say, it can't be real, it must come back. Their minds are anchored to the old range, but the tape has spoken. The range is broken. The stock has entered new territory. The trader who trusts the tape over his own doubts reaps the gain. The one who clings to yesterday's logic is left behind. Haven't you experienced that hesitation yourself, only to regret it later? So the lesson is clear. A gap from consolidation is not just another move. It is the signal that the stock has shifted from quiet accumulation to active advance. It is the dividing line between boredom and opportunity, and it carries more weight, more reliability than the flashy gaps that come after long runs. Context gives it power. Without context, it's just another blank space. With context, it's the opening gun of a profitable campaign. Most men come to the market with opinions already formed. They have read something in the papers, or they have heard a friend speak about a company, or they have convinced themselves that a stock is cheap or expensive based on their own reasoning. Then they look at the chart and see a gap, and instead of listening to what the tape is telling them, they argue. They say, this gap doesn't make sense. It should come back down. Or they say, the stock is already too high, I'll wait for a better entry. And in doing so, they reveal the great flaw of human nature in speculation. The desire to be right in opinion rather than right in results. A gap is the tape's way of presenting truth without disguise. It shows that something happened strong enough to push price beyond yesterday's entire argument, skipping levels as if they did not exist. That is not opinion, that is fact. The market has spoken, and the trader must decide whether to align with it or fight it. And every time a trader fights it, he bleeds. Every time he accepts it, even if it contradicts his personal belief, he places himself on the side of power. The difficulty lies in silencing the ego. Can you silence yours when the tape speaks louder than your logic? When I was younger in the bucket shops, I learned fast that the market doesn't pay you for being clever, it pays you for being obedient. You may think you know better, but the tape always knows best, and gaps are moments when the tape speaks in capital letters. Ignore them, and you might as well close your account. The men who prosper are the ones who set aside their judgment and let the tape do the talking. You don't need to know why it gapped, you only need to know that it did. Isn't that the difference between the professional and the amateur, the ability to act without demanding explanations? Every great run I ever caught began not with my opinion, but with the tape showing its hand. Many of those runs announced themselves through gaps. The public scoffed, saying, it's an overreaction, while the stock marched on to double or triple. Why did I profit while they complained? Because I believed the tape more than I believed myself. That's not humility for its own sake, it's practicality. The tape doesn't lie, but a man's mind lies to him all day long. You can test this principle in your own trading. Go back and study your losing trades. How often did a gap against you appear, yet you held on because you thought you knew better? How often did a gap in your favor appear? Yet you hesitated because it seemed too much too soon. The tape was showing you the truth in both cases. Your mind persuaded you otherwise. And in that gap between the truth and your belief, your money evaporated. Isn't it strange how the market always finds a way to punish self-importance? Now let's talk about discipline. Trusting the tape doesn't mean chasing every move blindly. It means observing with clarity and acting with consistency. When a gap appears in context, a breakout from a base, a surge on heavy volume, a confirmation of strength, you act. When a gap appears late in a move, stretched and unsustainable, you step aside. The tape is not a trickster, but it demands interpretation. It rewards the trader who respects its authority and punishes the one who insists on bending it to his own narrative. That's why discipline matters more than intelligence in this business. Do you think the market cares how smart you are, or does it care how well you obey its signals? The reason gaps test your discipline more than other signals is because they're dramatic. They feel exaggerated. They force you to choose quickly. That's where the struggle comes in. A gradual trend lets you rationalize. A gap removes the luxury of time. It's a sudden move, and it puts your conviction on trial. Can you follow the tape even when it feels uncomfortable? Can you abandon your cherished opinion when the tape contradicts it? That's the essence of speculation. The tape is always right. Your job is only to decide whether you'll side with it or not. Many traders fail because they want to impose meaning on every move. They want to know the news behind the gap. They want to be reassured that their intellect is still in charge. But speculation is not an intellectual contest. It's a game of alignment. Align with the strongest force, and you win. Stand against it, and you lose. The gap is a flare signaling where the strongest force lies. Some men need to read an analyst's report before they act. The professional needs only the tape. Which camp do you want to belong to? Gaps also train you to detach from hope. Hope is the death of traders. If you're long a stock and it gaps down violently, you can either accept the verdict or you can hope it will recover. If you accept, you lose small. If you hope, you risk losing everything. The tape has already declared weakness. Your opinion that the stock should bounce is irrelevant. The market never consults your feelings. This is why trusting the tape is not just a tactic, it's a survival mechanism. Gaps expose the truth instantly, stripping away illusions. There's another side to this lesson. The way gaps force you to ride strength without flinching. When a stock you own gaps up in your favor, your instinct may be to take profits quickly. You say, "This is too much, it can't last." But if the tape holds the gain, that's a sign of strength, not weakness. The professional lets the position ride, while the amateur sells too soon. Over and over, fortunes are lost because men don't trust the tape when it works for them. They cut their winners short out of fear. Haven't you seen yourself close a position after a gap up, only to watch it climb for weeks without you? The tape demands trust in both directions when it warns you to get out, and when it urges you to stay in. That balance is hard to master because it runs against natural emotion. You want to hold losers and cut winners. But the tape asks you to do the opposite. That's why most men fail. They're ruled by emotion instead of the tape. Gaps, because they are so stark, magnify this struggle. They give you no wiggle room, no time to rationalize. They put your trading soul to the test. The wealth-building principle hidden in this is repetition. One trade, one gap, doesn't make a fortune. But obeying the tape gap after gap, campaign after campaign, that's how wealth builds. Each time you set aside opinion and trust the tape, you strengthen your discipline. Each time you argue with it, you weaken yourself. Over the years, those habits compound. The professional compounds discipline into wealth. The amateur compounds opinion into ruin. Which road are you traveling? You don't have to predict. You don't have to know why. You only have to trust. When the tape shows strength through a gap, let it guide you. When it shows weakness, let it save you. The men who demand to be right are always broke. The men who demand to follow truth are always solvent. Gaps are one of the purest forms of truth you'll ever see in this business. A gap against your position is one of the clearest warnings the market can give, yet most men ignore it at their peril. They see the tape move against them and immediately try to rationalize, to explain, to hope. They tell themselves, it will come back, or I know this stock, it's just a temporary move. But the market does not care for your explanations. It does not pause to grant your hope. When price gaps against you, it is the market's way of saying you're wrong, plain and simple. The question every trader must ask himself in that moment is, will I respect the tape or my ego? In my early days, I learned this lesson the hard way. I would hold on to losing positions, thinking the market would return to my favored price. I was convinced I understood the stock better than the crowd, but the tape spoke otherwise, loudly, through gaps and swift moves. Each time I refused to heed it, I paid the price. That is the brutal truth about speculation. Every gap against you is a teacher. Some men listen, some men bleed. Those who listen eventually survive, and those who survive have the chance to prosper. When a stock gaps below your long position, you are witnessing a shift in sentiment you cannot ignore. The buyers who were holding back yesterday have suddenly lost confidence or been outnumbered. The sellers have gained control. And this isn't just a small imbalance, it's a statement. The market has moved beyond yesterday's consensus. It does not negotiate. It does not wait for you. If you attempt to cling to your position out of stubbornness, you are fighting a force stronger than any individual belief. Can you imagine standing in the path of a stampede and thinking your presence will slow it? That is what it feels like to ignore a gap against your position. One of the most difficult aspects of this lesson is emotional. Fear and hope collide in the mind. Fear of loss urges you to act, yet hope tells you to wait. The amateur trader often lets hope dominate, believing that patience will somehow force the market to conform to his opinion. But the tape is not magical. It does not bend to emotion or desire. It only reflects the collective decisions of all participants at that moment. A gap against you is not a suggestion. It is an instruction. The professional listens and responds. The amateur debates and loses. The first thing to understand is that respecting a gap against you does not mean reckless selling. It does not mean abandoning all thought. It means acknowledging that the market has moved decisively and adjusting your position accordingly. This could mean reducing exposure, exiting entirely, or waiting for evidence that the initial reaction is temporary. The point is to make decisions guided by market reality, not by the comfort of opinion. Every second you cling to a losing position, the potential for damage grows exponentially because gaps amplify movement. Have you ever noticed how fast a stock can move once the old range is abandoned? That speed is unforgiving to those who hesitate. Another important factor is volume. When a gap occurs on heavy volume against your position, it signals that the sentiment shift is broad and committed. This is not just a trick of the tape, it is mass psychology made visible. The weight of orders confirms that the gap is likely not a temporary anomaly. You must pay attention to the size of the shift. Conversely, a gap against you on thin volume might be more susceptible to reversal, but it still requires caution. Even small gaps have a way of testing your resolve and teaching discipline. How often have you seen a thin volume gap accelerate because others noticed it and joined in? The market rarely gives a second chance. The principle here extends beyond just individual trades. It is about survival and compounding discipline. The trader who consistently ignores gaps against him will experience repeated losses, erosion of capital, and ultimately, a loss of confidence. The trader who respects these warnings preserves his capital, keeps his mind sharp, and strengthens his instincts. Each time a gap tests him and he responds appropriately, he builds a foundation for future success. Over time, this habit of obedience becomes a competitive advantage. It is how fortunes are maintained over years, not just made in a lucky streak. A gap against you also teaches timing. One of the hardest lessons in speculation is recognizing when to cut losses versus when to wait for confirmation. The market often gives hints in the hours following a gap. If the stock continues away from your position with follow-through, that confirms the signal. If it begins to recover immediately, that could be an opportunity to reassess. But initial respect for the gap is crucial. Reacting too slowly or dismissing it entirely often leads to compounding losses. Speed and decisiveness. guided by observation, are your allies. Emotionally, the gap tests patience and humility. It forces you to confront the limits of your understanding. Many traders assume that because they have researched, they know better than the market. A gap against your position is the market's reminder that no single opinion carries authority over price action. It strips ego bare. The professional trader learns to swallow pride and act on evidence rather than conjecture. That discipline, once ingrained, becomes second nature and shapes the way he approaches every opportunity. The consequences of ignoring a gap can be severe. One misjudged position can eat a week, a month, even years of profits. The tape does not reward stubbornness. It does not provide comfort for those who cling to hope in the face of contrary evidence. The professional accepts the warning, adjusts, and moves on. In doing so, he preserves both capital and mental clarity, two essential tools for navigating the volatility inherent in speculation. A trader also learns from the patterns of gaps over time. Certain stocks, sectors, and conditions are more prone to explosive gaps.